Finally, we see some action in this market. Stocks are moving, stocks are dropping, the market enters a panic territory, everybody is freaking out. I love it. Hello everybody, welcome back to this new video. In this video, I want to assess the situation. You will get my opinion on what's happening right now. I want to comment on the situation so you can make an informed decision whether you want to buy your favorite names or not. Because the market is 5% of the all-time highs, but you have some specific names that are dropping. You have the fear and greed index at 6. Is this a good indicator or not? What does it tell you? Next question, how should you react right now, today? Do you panic sell or do you panic buy or do you hold and sit tight? This is what you are going to do today. This is what we're going to discuss today in this video. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And I love these opportunities when people are panicking, because this is when people are panicking that you can find the best opportunities. Because yes, the market is down 5%, but some specific names are down much more than this. Okay, so stocks are down. If you want to know why, nobody knows why. You will have rumors, you will find some specific little information. Nobody knows why stocks are dropping. Anything can happen in the short term. Valuations are stretched for the S&P 500, so any little shock, any little doubt will cause a market correction. Now we are not even at a market correction stage. To have a market correction, you need the S&P 500 to drop 10%. Same thing for the Nasdaq. And I think the Nasdaq right now is down, 7%. So we are not stocks. Let me put index here. Oh, that's the company. You know what? Nasdaq 100. And let's see what we have. We are, for the Nasdaq 100, we are down 8%. So yeah, not even a proper correction, and people are freaking out. People are freaking out because yes, the index is down 5%, but some specific names are down much more than this. Okay, and I can mention a few names. You have retail stocks, HIMS, Duolingo, all the quantum stocks, quantum computer stocks, all the chips. Micron, Lam Research, everything is down 15-20%, and it is dropping like a rock. At the same time, you have some fear of an AI bubble. Okay, what about this AI bubble? If you look at the big tech companies like Meta Platforms, we are down year on year. The stock on a year-to-date performance is flat. What about Amazon? Amazon stock is down minus 1% this year. So not everything is in a bubble territory. You have a few candidates here that are good. Even big tech is not in a bubble territory. I don't see why people say it's a bubble at the moment. I think the earnings we are seeing right now are pretty strong. So if the earnings are pretty strong, if the margins are extremely high, if you still have a lot of demand for AI, you don't have to worry about short-term volatility. The market is a little bit stretched, so sometimes you will have pullbacks. You don't have a clear reason why stocks are down. It happens. In the short term, anything can happen. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. With that, you have a couple of elements that show fear in this market. If you look at the fear and greed index from CNN, you are at 6, which means extreme fear. The last time you had 6 was in April during the tariff market correction. Some people don't like this fear and greed index. They say it's fake news, but I've been investing for a decade. It has always been helpful to me. So I'm aware some people don't like this index. I love this index, and I'm using this every year. When you have a market panic, this fear and greed index has always helped me. So this is what I use, and I tell all my clients to use this index because it's lovely. You can spot this index, you can have the consumer sentiment index also. We are entering panic mode right now. So it's very strange at the same time to have an index, the S&P 500, dropping 5%, but at the same time, panic mode. It shows several things. Either people had too much margin and people will get margin called. People took too much risks and now you have to fear the consequences of having too much risks. And I'm telling you, this correction will wash out all the gamblers, speculators, all the noobs, all the young beginners in this market that took too much risks, too much leverage, all the people that were trading options for fun. This, if you have a long correction, there will be a washout of these people. Unfortunately, this is the price of their lesson, and it will happen eventually. Every year it happens actually. Or maybe as the stock market is down only 5% and you have an extreme fear market, maybe this is the bottom. This is the local bottom here. Actually, if you look at history, every time the market dropped a little bit and we entered fear territory, it was the local bottom. As I told you, when fear is at the maximum, this is where you can have the bottom, but nobody knows. So in terms of probability, I don't worry that much about this market correction. I welcome the market correction because finally we have some action. Finally, you have some moves happening. Finally, I can buy some specific names I had in my watch list. Finally, I can buy more Fortinet. Fortinet is dropping and I love it. It's extremely good for me as a long-term buyer of stock to see discounts. And if you are a long-term buyer of stock, you want cheapness, you want discounts, you want panic, because you will be buying stocks on a cheaper basis. You are not forced to buy high-flying tech names that are expensive. You can buy reasonably priced businesses, great companies that you always wanted to have in your portfolio at a reasonable price. I believe Fortinet is in this situation. MasterCard is in this situation. Great company that I have in my portfolio, and I want to increase the exposure. So it's lovely to see some panic in this market. MasterCard is an extremely good quality company trading at a reasonable valuation, and I uploaded a video about MasterCard a few days ago if you want to know my clear opinion about this one. Okay, now I want to comment on an article from Adam Koo. I believe this is an article that Adam has for every market correction, because I've seen this article before, and I think it's great. And it's great of him to just republish the same article, because every time it works. Real words of wisdom. Okay, so Adam Koo, by the way, you can subscribe to his great YouTube channel if you want more investing content. The stock market is going through a pullback right now, a wave down after a wave up. And if you are an investor, you are probably seeing a drawdown in your portfolio, which is maybe happening for you. Maybe the stock market is down 5%, but you are down 20%. For a lot of people, this is happening, okay? If you want to know my portfolio, I think it's still fine. I'm still following the market. The S&P 500 is up 11, should be up 11% here. And I'm up 15%. So I'm still having a 4% alpha on this market, still outperforming this year. I did not lose my outperformance, and I'm pretty happy about it. So far, we will see how the year ends. Okay, how you feel and how you react to portfolio drawdowns will determine how profitable you will be in the long term. This is all about psychology. Here are a few useful psychological tips. 1. No matter how great an investor you are, you will experience your portfolio value going down through temporary drawdowns. Legendary investor Peter Lynch, who achieved plus 600% returns in his 13-year career, saw his portfolio drop 27% to 56% several times throughout the process. It will happen. It will happen. Stocks will go down eventually. You can't go up to the sky forever. Even the most skillful pilot in the world cannot avoid turbulence. If you accept the fact that the temporary market declines and portfolio drawdowns are part of the investing journey, and you have no control over when they are going to happen and how strong they will happen, you will stay calm and relaxed. Just assume if you want to invest for the next 10 years, 20 years, you will have every 2 years stocks that will go down 20%. This is it. And every year, you will have a moment when stocks will go down by 10%. Maybe once, maybe twice per year, stocks will go down. And after this, stocks will go up. If you sign this deal and you are a happy player, you know what to expect. So if you know what is going to happen, stocks will be volatile, you don't worry much. I don't have any anxiety with my portfolio right now because I signed the deal, playing this game, okay? It's a long-term game. Life is a game after all. So you want to create a great portfolio, and eventually, even if the quality of the portfolio is great, stocks will go down eventually. What is great, if you have dry powder, you can invest more. You can increase your capital and be more exposed to this market. As I told you, I mentioned Fortinet and MasterCard. Right now, I'm thinking of buying more Fortinet and MasterCard. Great quality companies available at a fair price. Okay? And you didn't have this a couple of months ago. So this is lovely. If you accept the fact, you will stay calm and relaxed. Okay, second point. Remember that the current market price of a stock does not always reflect the actual value of the underlying business. You can look at Google. A few months ago, in May, in June, people hated Google. The stock in May was at $160. And now the stock is at $300. People love Google. It was 6 months ago, guys. So yes, over 6 months, anything can happen. Be ready. The sentiment is weak. People are weak in this world. And stock investors, stock gamblers are weak. They have weak conviction and the stock price will fluctuate a lot. In the short term, prices are driven by market maker manipulation, high frequency algo trading, forced selling by brokers on leveraged accounts, panic selling, etc. For example, in a market sell-off, a high quality business like Amazon or Google may see its stock price sell 20% or 30% lower. However, the business itself has not changed. It's making the same revenue, profits, and free cash flow. Its intrinsic value is the same as it was a week ago. Intelligent investors focus on the value of the underlying business and not the temporary mispriced manipulated stock price. Anything can happen in the short term. The only difference whether you can outperform the market or not is what do you do when other people panic. If you hold a high quality business and crazy Mr. Market decides to sell it at 20% lower the next few days because he's having a panic attack, you have not lost anything unless you are crazy enough to sell it together with him. If you are selling stocks just because they go down, it's bad. It's not a good reason to sell stocks. Either the story has changed or the valuation has been too high. But if you only sell because stocks are going down, this is a mistake. This is a mistake. You have to know when to buy and when to sell. Knowing when to sell is extremely important. If you panic sell because the stock is going down, you will panic buy when stocks are going up. So this is the definition of sell low, buy high, which you don't want to have, right? Many people have panic sold in April 2025. And then stocks rebounded and they bought at a higher price. It is a mistake to do this. So you want to avoid panic selling, which means you want to know your stuff. 3, focus on where the value of your investment portfolio will be in 3 to 5 years or more. If you are invested in high quality businesses, you should expect that your portfolio will double in value in 3 years, which means 24% annualized. to 5 years, which is a 14-15% annualized performance. In 10 years, your portfolio should be 4x to 9x more than the value today. When you focus on the destination, the temporary downs in price should not bother you at all. In fact, you should be looking at it as a chance to add more to your portfolio. You have a great quote from Warren Buffett who says, if the price of socks goes down, I'm a happy buyer. I can buy more socks. Same thing for trousers, t-shirts, because you will be a buyer of socks and t-shirts your whole life. So if there is a discount, next March, for example, why don't you buy more? You buy more socks. Well, similarly, you buy more socks when they are cheaper, you buy more stocks when they are cheaper. Same thing is true. If you want to be a long-term shareholder, you want to welcome these drawdowns. You want to welcome volatility. It will help you. When the pilot knows that he will eventually land at his destination, he does not freak out over the turbulence. 4. Your words affect your thoughts, and your thoughts affect your emotions and actions. Oh, this is a great point. Avoid using words like bloodbath, I lost X amount of dollars, portfolio bleeding. These words create negative emotions as they assume that you have lost something and that your investments are declining in value. Same thing is true if you scroll on Twitter or if you panic sell and you binge watch videos on YouTube with red thumbnails. People will call for a crash. Maybe I will put the word crash in the title of this video because it makes more views. Yes, maybe you can watch 1 or 2 or 3 videos. But some people will watch dozens of videos only looking at the negative stuff. This is not helpful at all. You don't want to panic sell and only watch negative comments. It will lure you. And guess what? Most of the time when stocks are dropping meaningfully, especially after a strong earnings report from Nvidia, normally stocks rebound. As long as the economy is fine, as long as the earnings are fine, if you look at all the other times it happened in the past, stocks rebound. We have seen the exact same phenomenon in July 2024. Massive panic selling because of the Japanese carry trade. Who remembers this? Who remembers this? And who knows how to explain this carry trade? Well, the situation in Japan now is worse than what we had last July in 2024. But nobody cares because earnings are going up. Okay? So every time the market drops, you will have a very good reason to sell to sound smart. As always, bears sound smart. Bulls make money. As always. So by definition, you want to buy the dip. Not buy the dip in the index, because maybe you think the index is overvalued, is expensive. But you have great opportunities in this market. I mean, right now, today. 5. Avoid saying I should have sold before the drop. There is no way to consistently predict short-term price moves in the market. Yeah, anybody who says that they have a crystal ball is lying. Anybody that is doing some market timing is lying. By entertaining this thought, you will likely sell in panic whenever stocks start to dip down slightly or when a market expert predicts a drop in the future. Same thing, maybe you're binge watching videos on YouTube or scrolling on Twitter or watching CNBC and you want to see what experts have to say. I've been in this field I've been listening to experts in this investing field for more than 10 years. It's a waste of your time to do this. So please avoid listening to experts all day long. They have no clue when the market will rebound. I have no clue. You have no clue. Warren Buffett has no clue. Nobody predicts what the market will do in the short term. In the long term, you can have a pretty good idea. In the short term, anything is possible. It's better to be agnostic and just welcome the prices as they are. Don't waste your time scrolling on CNBC television, listening to some experts, reading a really good, well-written article online about why the market should never bottom on a Friday. Come on, let's be serious a little bit. Nobody knows. Nobody knows. All these expert guys will delete their tweets if they are wrong. So yes, nobody knows. Don't try to sound smart. As a result, you will never stay invested in the markets long enough to compound your wealth. Yep. 6. Use temporary stock market corrections to add more shares to high quality businesses that you want to own more of. You can never predict how long a correction will last or when the exact bottom is. So it is best to buy in small tranches to average in your position until it's fully allocated into a well-diversified portfolio. Okay? If you are already fully allocated and or you have no more cash to deploy, ignore the temporary market price and go watch a movie or Netflix instead. Come back a few weeks or months later and you would have likely forgotten that the market correction even occurred. I remember this article was written a few years ago and it was also very useful in July 2024. Now you are watching this video today. Can you please remember how you felt in July 2024? No, you can't. Nobody remembers. And I believe the same situation will happen over and over again. Stocks will drop, people will panic and will sound smart, and then they will recover and they will forget. Every time this is how the world goes. Okay? Same thing in October 2023. Here, same thing here. Markets dropped. People said you will have a local bottom, a double bottom. We will go back to the prices we saw in 2022. Guess what? The market didn't care at all. More earnings, more revenue, more AI investments. Stocks go up, earnings go up, margins go up, valuations went up. So you will have plenty of smart people telling you smart things online. And if you look at the economy and the profits, everything is fine. For my companies at least. So yeah, I'm not panicking at all about this market drawdown. Please go back. Please go down more. Please go down 10% more so I can buy MasterCard a 10% discount. Please go down. Please, I'm very happy to have a market crash. I'm very happy to see stocks go down 20%, 30%. Come on, bring it on. Bring it on. So yeah, but I don't think it will happen. I don't think we'll have a market crash of 30%. If you don't have a shock in the market, for the moment, it's a no-no, especially in this cycle. But anything is possible. So now that you have all this information, what should you do? The simple answer is, if you find a good quality company that you like, you think they will grow in the long term, and the stock has dropped, if it has reached a reasonable valuation, you can buy. You can buy your best ideas right now. If you think it's a reasonably priced, great compounder in the long term, this is a golden opportunity to accumulate more shares. If you don't buy now, when do you buy? Frankly, when do you buy? Another thing that can be helpful is now that everybody is freaking out, you can take the time to look at your portfolio right now, today, and ask yourself, are the valuations reasonable? Or do I own very speculative, expensive stocks? A good way to survive in case you have a bear market is to avoid expensive companies. Second thing, you want to check your portfolio today and say, do I have a lot of companies with a lot of debt? Most of the time, companies that go bankrupt are unprofitable and filled with debt. So if you reverse engineer, the best way to survive in case we have a bear market, in case we have a crash for some reason, is to only own profitable companies and only own companies that don't have a debt problem. You can totally avoid debt if you want, but at least they are not over-leveraged companies. Boom, you have reversed engineer the way to survive a bear market. Also, third thing is, do you have hedges in your portfolio? Do you have defensive plays in your portfolio? I'm thinking of publishing a video. What are the best defensive plays you can have in this market environment? It will be a pretty good video. I have never published this kind of video in the past. Do you have hedges? Do you have defensive plays? I talked about MasterCard before. It's a defensive play. They don't have a debt problem. They are benefiting from inflation. They will do fine regardless of how the economy evolves. And every time you had a market drop, MasterCard did not drop that much. You can look at the performance in 2022. MasterCard was almost flat when everybody lost 20%. So yeah, you have defensive plays. Another example is AutoZone. AutoZone is a defensive play. Orally is a defensive play. Do you have defensive plays in your portfolio? Some things that are not really correlated to the market. Special events, special situations, value plays that are good hedges. These are good questions to ask. So 1, do you own expensive stocks? 2, do you own over-leveraged companies? And 3, do you own hedges or defensive plays? This is the kind of questions you want to ask when we enter this panic territory. Stay disciplined, don't panic sell, know what you own, and happy hunting to anyone who's buying the dip. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.